Hey folks, glad you could join us on another episode of Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. We want to talk about the Kenyan Mortgage Refinance Company. The last time I sat with this gentleman, that's Mr. Oltetia, we were talking about KMRC going to market to raise debt. We haven't met ever since. It's a delight to be back. J.O., karibu sana.
Thank you.
Always a pleasure, man.
Very nice to see you.
I combed through your FY24 numbers. Fantastic performance. The banking sector, by and large, had a struggle with cost of funds last year. You see it, if I could call it, on the secondary side because you're not front-facing. You on-lend to primary mortgage lenders. How was it on your side, by the way?
Oh, it was a good run on our side. So we had, the rates were good.
Yes.
So I think that's what favored us most. So we had a very, very good run last year. Now, when you look at our core business, which is essentially lending, we had tremendous increases on the mortgages that we disbursed to the market last year. We did, almost 5 billion out, and that in itself is a significant increase compared to the previous year.
Yeah.
The other key driver was, of course, the interest rates in the market were very high.
True.
So we have some money that is in transit, and we decided to sweat our balance sheet a lot more as a result of that.
Okay, all right. And majority of the banks, who are now your primary mortgage lenders, struggle with credit risk, and especially within the mortgage book. So I wonder, when you look at your asset quality, the one that you have on lend, is it beginning to show in your numbers as well?
Yeah. So the beauty about our lending procedure is that the obligation or the credit risk is actually held by the financial institutions.
Okay.
In this case, we have banks and the SACCOs. Now, so we don't have defaults of any kind. And I think the underwriting processes have also been up to standard in all cases, actually. Because usually what happens is, should a financial institution default, in fact, if a mortgage in the pool of mortgages that we have refinanced goes bad, there is an obligation to replace that particular mortgage.
Yeah.
But we haven't actually replaced any. That means none went bad. But generally, in the financial sector, the non-performing loans were about 15%,
Yeah,
which is
60 there.
which is a significant increase, I think, compared to the previous years.
Yeah.
But they had very little effect on the KMRC refinance mortgages. That means we have a lot more robust underwriting processes that we have put in place, and the financial institutions that are equally working with us have also implemented more robust underwriting frameworks.
J.O., as I said at the start, the last time you and I sat down, we were talking about your capital raising. It's been a couple of years. I'd imagine you are thinning out the capital that you had raised. What's your plan around your capital base? Do you intend to go back to market? Are you still speaking to the DFIs, or how will it play out now?
So now we disburse all the funds that we raised in the capital markets last year. So we actually wanted to go back to the market last year. We couldn't, for obvious reasons. Now we are planning to go to the market next year, 2026. We have, I think in our view, we think the markets are beginning to have a correction. At the moment, the short-term rates are single digit, which is great. If the same trend continues for the medium-term bonds, then certainly by the end of the year we'll have more clarity, and that way then we can go to the market next year. When we issued our bond last year, we issued it at 90 basis points above a government instrument, which is a benchmark. So the rates were around 11.5%. We expect that the rates are going to come down to maybe around 12% by the end of the year. That's for, say, a 5-year bond. And that way, we should be able to go to the market with that kind of rate. So we are actually preparing to go to the market for that. The other option that we are considering, and of course, we do blended finance, is that we expect to raise more fund from DFIs. The nature of funds that we expect to raise will be slightly different from what we raised initially. And that's because, of course, sustainability is now a key issue. We want to do green. We're encouraging a lot more of green housing or green mortgages for that matter. And that is the kind of discussions that we're beginning to have with the DFIs. But the most fundamental thing is we will still continue with blended finance. And that's the approach we want to take. So we tap capital markets and we do DFI financing at the same time.
Okay. There's quite a bit to unpack there, Jo. So let's start from here. One is ballpark figure. What kind of ticket size would you be looking to raise next year?
So we haven't determined that yet. That usually depends on the kind of gap that we have. We don't have a significant gap just as yet. Actually, we have enough funding with the DFIs, but we want to blend. So we're still thinking or considering the kind of ticket size. We should have this discussion at the end of the year. I'll tell you the ticket size that we'll be considering.
Okay. And it sounds to me like you're very keen on going to market with a green instrument. Ever since a player who focuses on student accommodation finally had their redemption and they exited the market, there is no green instrument in the market. But it would be nice to have it. Is that what you have in mind?
Yes, we do have that. But should we not? Because you see, there are conditions precedent for that. One of the key condition precedents is, are there properties that we can lend against? So we'll have to check the market to ensure that there are green properties, green mortgages that are provided by financial institutions that we can lend to. Now, because that's a distinguishing factor between a normal or a common instrument and a green one, it's just the utilization of funds. Now, we have been having engagements with IFC and a number of other financial institutions that are keen on green finance, green mortgages. And we understand there are actually a few institutions that are already doing that. In fact, we have one bank which came to us and said we are testing our green mortgages framework. So that's essentially what we're going to look at before we go to market with a green bond.
Should the markets not correct and continue in the terrain that we are seeing? Because the macros are changing every day, and as you have seen from the Trump effect from the States, we have seen corporates, at least one major corporate, going the route of what is now being called a sustainability-linked bond, arranged by a couple of players in the financial institutions. Would that be an option on the table should the market conditions not be favorable for you going with the debt raise?
So we want to take gradual steps. You see, because we lend to financial institutions, KMRC alone will not be able to determine the approach or the kind of instrument that we need to have. So essentially we'll have to check market readiness for us to be able to issue whatever kind of instrument that we have. We don't have issues with plain vanilla yet, which is essentially a plain vanilla green. That is still okay. We can go to more structured instruments as the market grows. So it depends on the level of market development, which essentially is also something that we like to encourage.
Okay. One time we were in a forum where you did indicate to me that plans were underway for a mortgage guarantee structure that would enable you to push mortgages further downstream in this market. Any update on that?
Oh yes, we have essentially almost finished with a mortgage guarantee. So we call it a risk sharing facility because the idea is to de-risk financial institutions, to de-risk banks and de-risk circles so that they can be able to go, or they are a lot more encouraged to go down or further down market. So we have what we call Kenya Mortgage Guarantee Trust. Essentially we registered a company which is in form of a trust that is distinct or separate from KMRC. And the reason why we did that is it has a whole lot of different risks compared to the kind of risks that KMRC takes. And we, as much as possible, would like to have KMRC as a low-risk financial institutions for these reasons that we keep going to the market. And as a frequent issuer of bonds, we want the investors to see KMRC as a low-risk instrument or institution for purposes of potentially raising lower-cost funds. Yeah. Now, so we distinguish Kenya Mortgage Guarantee Trust with KMRC. It will have its own balance sheet. It will, of course, manage its own risk separately. So it will be an institution under KMRC, but it's run separately, completely with a different governance. And that we already have. Now, we also had to develop frameworks. You know, initially, before we went there, we did a feasibility study and determined that the market actually needs this kind of instrument. So already we have the operating frameworks together. We had consultants last year who essentially developed the frameworks that we need. We did some benchmarking to compare with a number of other institutions that have done the same around the world, and we have a few, and we are ready. So the stage where we are right now is capitalization. Okay. So we have an indication already from the World Bank of 4 million euro of capitalization, which will essentially be the seed capital for that institution. The most important thing about this is that we still have a challenge, and so far KMRC is addressing an affordability crisis on home loans in Kenya, and that is driven mainly by cost of construction, which is high, expensive land, and to some extent limited financing. Now, when you look at rent, for example, as a share of household income, it's around 40%, which is a clear indication of an affordability crisis that we have. Yeah. It's very high. In most jurisdictions, I think they recommend is about 30. If it could be less, better. Yeah. So with about 37 to 40%, that's already very high. And that's a clear indication of a crisis that we actually face, that a majority of the people, particularly on the low to income, to middle income, are completely unable to afford decent housing. Yeah. That's the solution that KMRC has been providing, you know, to the extent that we're giving low-cost funds, single-digit rates, fixed rate, and even longer term, which essentially makes monthly repayments to be lower for people to afford. That is the kind of solution we've been providing to the country to support housing. Now, the mortgage guarantee will be an additional layer, and that will essentially help a lot more because it reduces the risk to a lender, because the default risk is reduced or manages that default risk. To a borrower, it helps a lot because when you have a default risk reduction, the expectation is that the financial institution should actually even reduce the cost of funds even more because there is a guarantee, right? Yeah. The other one is with high LTVs, you know, now, for example, you don't need deposit or to have a savings for you to be able to deposit because the guarantee covers high LTV mortgages. Yeah. So that kind of solution helps the lower income, particularly first-time home borrowers, the people in the informal sector, and essentially people who do not have a regular income. So that's a solution that is an additional layer, which we believe will push the financial institutions even further lower market to be able to generate those mortgages of the people who, at the moment, will not meet traditional underwriting standards.
Two quick follow-ups there. One, I'm very curious as to the architecture of this guarantee. In terms of the risk sharing, what proportion is taken by the guarantee facility? What proportion will be taken by the bank?
Yeah, thank you. So far what we have, and we have tested this with the market, we have had a number of stakeholder engagements with the financial institutions. The cover ratio, which is what you're talking about, is 40%, which we believe is high enough. So for example, if you take a mortgage of 1 million, the guarantee covers 400,000, which is very good already. Now, the financial institution, the rest of course will be the risk that will be borne by the financial institution, right? And that means that we have to avoid a moral hazard.
Yes.
If you have a 100% guarantee, why will anyone have underwriting standards? If you have a 50% guarantee, which is on a 50, absolutely. That's the perversiveness that we're trying to avoid. And that's why we agreed on a 40. So when we started, we tested with what a few jurisdictions have, like Malaysia, for example. Chagamas has or covers 25%. So we thought we needed to encourage the market by increasing it a lot better in Kenya, so that we can have the market essentially acceptance fast. And that's why we went to a 40% cover ratio.
Okay. My second follow-up to that was this. 4 million euros, JO, is not pocket change. And you're still referring to it as seed capital. Are you still capital raising? And how long would the 4 million euros cover you in terms of runway?
So 4 million euro is good money, but not nearly enough. We want to have a sizable guarantee fund that actually will cover the market for long. But initially we've done some analysis and we have determined that the 4 million euro will take us 9 years. Yeah. Assuming that we have a few defaults every year from year 2, that means it will take us 9 years. Should there be no defaults, and we've checked Malaysia, for example, and Pakistan, which is a little more recent, they have actually had no default for the last 7 years that they have been running, absolutely none. But we, of course, had to assume in our analysis that we'll have a default or 2 every year for those 9 years. Now, if we don't get, that means that fund, because it also grows every year, of course, there will be an investment for that, and then that means that the money will be plowed back into the fund, and that will take us even longer. But what we want to do is that we want to raise more funding. We want to capitalize this a lot more, so that we can take, it can cover a lot more risk that we should anticipate. And so we are in discussion with a few other DFIs who are actually keen. In fact, one of them came here and said, you know what, if you are doing that, we believe that will have a high impact in the market, and we are ready to have a discussion for possible additional funding for that guarantee fund. So we don't want to assume the 4 million euro is nearly enough. We want a lot more so that we can encourage the market even more to come down.
Do you have a target in mind?
Yeah, we want to have at least 1 billion shillings of risk capital for that guarantee fund. That's what we are looking in the medium term.
Jay, one of my friends who is a very keen watcher of KMRC always asks me, why is KMRC struggling with pushing mortgages downstream, yet the market already has solutions for that space? The reason why our parents own houses they never bought, or they built themselves, is because they relied on incremental financing from their institutions like SACCOs and the likes. Yeah. And the way that worked is, why it was incremental is for the risk mitigation. So you do your first floor, they see how you're servicing that debt, then you can do your next, etc. How would you respond to that, Gio?
So, number one, okay, let's just look at the numbers. It's true. In the village or in the rural areas, over 86% of the people own their homes. I know how they own them. They have communal land. They have family land and that kind of thing. They really did not buy the land, so they do the constructions. Now, and the construction does not have to be terribly decent. It doesn't have to be very, very decent. So, but they have a structure anyway that they call home. In the urban areas, on aggregate, the home ownership is only about 23%. And you know what? We have a rush to urban. We have almost 500,000 people moving to urban areas every year here in Kenya. That means urbanization rate is significantly increasing. Now, so that means housing, the deficit we have is a lot. Last year and a few years back, we're still talking about 2 million housing units as deficit. The houses that come to market is only about 50,000, at least up to 2 years ago. Maybe that will change. So we have a significant deficit of over 150,000 to 200,000 units every year. Now, incremental housing development is okay. It's not bad, and I will show you how we are going to support that. But it's inefficient. It's terribly inefficient. Do you know why it's inefficient? It's cash back. It's cash reliant. Yeah. So you need to build cash, savings over time for you to be able to do that. The other alternative, of course, is to borrow from microfinance and SACCOs and things like that for you to be able to build that. Now, the inefficiency here is that you are deploying cash into this, but you're still paying rent, right? Yeah. So eventually it's actually going to be very costly. You're building over time a slab, okay, you raise it, and takes you, I think there was a study that showed it takes about 5 to 7 years to complete a house incrementally. For all those years, you're paying rent. Of course, you still have to meet other costs and things like that. And you have already deployed funds here that you are really not utilizing. So that creates a terrible inefficiency. So what we are saying is we do a blend of those approaches that we had in the past and now potentially get approaches that are a lot more efficient. At KMRC, we are offering solutions this way. Number one is as a mortgage or a home loan of a house that is ready. Now, if you prefer to buy and build, you can also get a mortgage for purposes of buying to build. Because in the city, unlike in the rural areas, you really don't have the land. You have to buy it and then you start the construction. But then you'll get the financing to do the construction and potentially do it faster. The other approach essentially is on rent to own, which is usually a ready home already anyway. So a TPS and a rent to own arrangement is almost similar. And that means the home has to be ready for you to be able to get there. But the difference between a home loan and a rent to own arrangement is the fact that timing is an issue. Yes. Now, on a rent to own arrangement, you get into the home immediately. On this purchase one or on a mortgage, it takes you a few months to be able to lock or to close in on the mortgage. Now, so those three approaches we believe are a lot more efficient to be able to encourage people to buy homes faster and own them quickly and be able to operate with the other costs a lot more efficiently. Otherwise, if you just rely on incremental, it's okay, but it's not efficient.
I see. Yeah. I'm being flagged that we should be dialing down our conversation, Jo. So one is, how is your pipeline looking like? And I'm asking that because, of course, you're going to market to raise capital. How does the demand side look like?
Very good. So we have, you see, last year, we opened up our lending approach to to essentially every institution in the country that offers mortgages. Initially, when we had this conversation, we had 20 institutions who are shareholders of KMRC, who are the only ones we could lend to. We thought that was not nearly enough, and we decided to open it up to everyone. Now, we immediately doubled the number of institutions that are lending to, and now we have another 20 that have already signed what we call a master agreement, which is actually the terms under which we can work with them, which is a commitment. Now, what does that mean? It means the demand is now higher. So far, this year alone, we have built about 9.5 billion of a pipeline of mortgages that people would like to have. That means the demand or the need for KMRC funding is increasing more significantly, and that means that's why we need a lot more money going forward. So essentially, the demand is good. On the flip side, the supply is not moving nearly as fast as the demand, and that's why we still have a shortage. But we are aware that the government is doing a lot through the Affordable Housing Board on the construction. Of course, they have not come to market yet. We're still waiting to get that for them to come to market. And KMRC is actually ready to refinance a majority of those homes that are being constructed by the Affordable Housing Board and the State Department for Housing. So at the end of the day, it sounds like within a year or two, the demand and supply have some kind of point where they seem to be getting better. Because at the moment, the demand is far higher. It far outstrips the supply.
Final question, Jo. Has an equity raise ever been on the table for KMRC? And I know it's still early days in terms of an institution, but is it something which you have toyed in your mind with? What have we decided that we can decide to invite the public to ownership of this entity?
So we haven't, that is going public. We haven't thought of going public just yet, but KMRC is a public institution. It's a public limited company. So we have a number of institutions, of course, who are shareholders, but that's not really public as a listing of such. So we haven't really thought about a listing yet. The closest we thought was to invite the additional shareholders to come in, or the additional institutions that are currently not shareholders of KMRC to come in as shareholders. But the process takes a little longer. And therefore, that's why we opened and said, okay, even if you're not a shareholder of KMRC, we will still lend to you nonetheless. But maybe in future, it's something we may want to consider, whether or not we actually want to go to the stock market and issue shares. At the moment yet, not yet.
Not yet. Give us your parting shot, Jo.
So my parting shot is, now we have solutions that we believe are going to sort out the crisis we have on affordability. The risk sharing facility is one of them, which is actually making better. The other one is what we're providing in terms of the current KMRC products. You know, the fixed rates that we have, the fact that the funds are single-digit rates, and that is to the ultimate borrower. So we believe that is a solution that we may drive the market to a level where the contribution of housing to GDP will increase. At the moment, the contribution of mortgages to GDP is only about 1.8%, which is terribly low. Our medium term is actually to drive that to 3%, which I believe will be a lot more sizable. But remember, the housing contribution in general, the real estate contribution in general is just about 10.5%. But that's still low. But that's now residential housing, commercial housing, and things like that. We don't have nearly enough numbers or data that can help us to track the residential housing alone as a contribution to GDP, and that's an area that we're going to be working on.
All right.
Thank you.
We've been having a conversation with Jo from KMRC about the strategic outlook for the entity. Remember, they should be going to market next year, and that is 2026, looking to raise capital to continue this business of on-lending to primary mortgage lenders, and we see if we can push mortgages further downstream in this market. We shall be keeping tabs on this development. And also we've touched on the mortgage risk sharing facility, also geared towards, if I could call it, democratizing mortgages to the mass market. That is you and I. We shall continue highlighting these issues for the interest of the public, so stay tuned to Business Redefined.